Hey guys, what's up? So we're gonna get into basically what I'd like to call the market cycle, or just a general cycle that the market goes through. We can call this the market maker cycle, because this is basically a cycle that smart money uses to sort of essentially make their funds flow. Obviously, money has to flow from, or rather, when an institution or when smart money wants to change from being a buyer to a seller, that money or the exchange of their money from buying to selling happens over a gradual process. Now, within this whole smart money cycle, I guess it's only right to mention Mr. Wyckoff himself. So, a lot of us have heard of Wyckoff. Um, the dude that actually came out with this whole Wyckoff theory is Richard Wyckoff. Now, basically, Richard Wyckoff is one of the titans of technical analysis. And I guess out of the titans of technical analysis, the only people that we really, or that a lot of people know, would be Mr. Dow, Mr. Elliott, and Mr. Wyckoff himself. Um, so basically, Wyckoff proposed a method to help understand price movements. Um, and so, what he proposed was for us to think about the market as a whole and to think about the movements within the market as a whole. And he basically says, this is a quote by Wyckoff himself. He says, all the fluctuations in the market and in all various stocks should be studied as if they were the result of one man's operations. Let us call him the composite man, who, in theory, sits behind the scenes and manipulates the stocks to your disadvantage if you don't understand the game as he plays it, and to your great profit if you do understand it. So that's basically a quote from Wyckoff himself, and basically he advised traders to basically just understand and play the market game as the composite man plays the market game. Now, we're gonna go into basically what the composite man really does. How does the composite man actually think? So, the composite man carefully plans and executes and concludes all of his decisions. The composite man also attracts the public to buy a particular asset which he has already accumulated a sizable amount of shares. One must also study the charts with the purpose of judging the behavior of the stocks and of the charts and of whichever currencies and all of the motives of the large operators who dominate those charts, because we know that, guys, we are not trading the markets alone. We are just part of the market participants that are involved in the transactions that happen over, regardless of which stock it is. You can think of any stock. Any stock has big players and it has small players as well. With the study of price, one can actually get the ability to interpret the motives behind the action that the chart portrays, guys. So we're gonna start off by just showing you roughly. I'll just get this drawing tool. We'll just start out. Every market, guys, starts somewhere. Now, eventually, a market goes through what we will call an accumulation phase, and then you see, after the accumulation phase, basically the accumulation phase is where orders are being placed in anticipation for higher prices. Now, after that accumulation zone, we then see something called a markup. Now, a markup is basically when we see higher prices. After every markup, at the end, or rather, let's say at the end of every markup, we find what's called a distribution phase. Now, a distribution phase, you could assume that a distribution phase could be one of two things: either profit taking from the markup, or short selling, preparing for lower prices. And then after we see this distribution, we basically see what's called a markdown. Now, I actually have drawn a lot more descriptive, or a much more descriptive model of what I just explained now, and we'll just go into that briefly. So like I said, guys, an accumulation happens in expectation of higher prices. In this area, guys, institutions are basically adding their buy positions with the expectation of there being higher prices to follow. Now, after this accumulation phase has occurred, what we see is prices moving to the upside, and then along the way we find reaccumulations. Now, a reaccumulation could come in the form of a corrective structure, could come in the form of a continuation structure, could come in the form of a simple pullback or a retracement. Now, in a reaccumulation area is basically where more orders are being put in for higher expected prices. So we find these accumulation areas happening in between the markup. After every markup, guys, we just discussed it, after every markup we find what's called a distribution. Now, like I just said, a distribution could be for one of two, or could be happening for one of two reasons. Either profit taking from all of these buy orders that were executed, that were added during the markup, during the accumulation, during the reaccumulation, and as well as during the markup itself, we could see profit taking, which means that all of the buy orders that were opened are now being closed, and we see that obviously printed on our chart in the form of a distribution. Or a distribution could be the intro of short sellers. Now, we know we are traders, guys. We buy and we sell. So this distribution could also be a result of people beginning to short sell the market, or let's say the composite man beginning to short sell the market in expectation of lower prices, guys. So every distribution happens for one of two reasons, either profit taking or short selling. Distribution happens before the expectation of lower prices, guys. So along the way, these lower prices, or the impulsive move to the downside after a distribution, is called a markdown. Like we have explained, it's in expectation of lower prices, hence the term markdown, because prices are being marked down. So along the way, or along the markdown, we have what's called redistribution. Now, redistribution is again could be happening for one of two reasons. Could be happening for additional short selling or short positions being added along the way during the markdown, or could be from profit taking, guys, because remember, when we do see prices actually breaking down to the downside, we understand that there are traders, guys, that are hopping out of their position. So obviously, if this is not institutional, or if only institutions are not jumping out of their positions here, we do have retail traders that are looking at these areas here and are seeing breaks of structure to the downside. And when they see breaks of structure to the downside, if they are involved in buy positions, they obviously jump out of their buy positions because they want to keep their profit. And as well as anyone that decided to start buying from these areas here, obviously only retail would buy from a distribution area. Once we see a breakdown of prices, retail starts to jump out of those buy positions because they're in a negative. Hence, we see these redistribution areas, or areas where the market pushes down, stalls, and redistributes orders before the continuation of the move to the downside. Now, at the end of every distribution or markdown, we then see an accumulation, which happens again. So this is basically a general outline, guys, of the market cycle, the Wyckoff cycle, guys. We just have accumulations, markups, distributions, markdowns. That's the basic cycle, guys. So we're gonna actually just go into some Wyckoff a little bit later, but for now, guys, let's just internalize the structure, internalize the cycle, and then actually begin to go onto the charts and start looking for these areas of accumulation, markups, distributions, and then markdowns. So guys, here we are on CAD yen and we are on a daily chart. So now I just want us to basically just run through the market maker cycle or the Wyckoff cycle just to identify these phases in the chart or on our charts. So to begin with, we can already spot our lowest point and our highest point. Now obviously guys, this is very simple to do in hindsight, and it does take us to, or it will take us to actually go into the actual attributes of what an accumulation looks like, what a markup looks like, what a distribution looks like, to be able to identify these structures happening in actual market time. Now we're doing this in hindsight just for the demonstration and just for the understanding of these cycles. Now we'll go ahead and identify this lower portion here of the this market as our accumulation area. Now what happened after we saw this accumulation? We then found a reaccumulation, guys. During the markup, we then found a reaccumulation happening over here. We also see another small reaccumulation happening just up here. Now, where do we actually find our distribution after this markup? Now, the reason why I picked this example here, or this piece of price action, is because I wanted to actually point something out to you guys, is that as much as we understand where accumulations occur, where distributions occur, no one knows, and we have no idea to ever know, we will never know how long these accumulations will take and how long these distributions will take. And we'll just go out and point out the fact that this whole area here, this whole box, could be considered as a distribution phase. Now we see a very small markup, or what I would assume in this case is a small markup. But within this markup, guys, if we understand the phases of the market, there are countless opportunities for us to end up, or at least to be able to capitalize in these buying opportunities all the way to the upside. Now, what happens when we see a distribution form? Now we know that there's going to be countless opportunities to be able to capitalize on the markdown, which is the move that happens to the downside. Obviously, distribution happens in expectations of lower prices. Now, that's basically the main reason why we're going over this. This is just a quick overview of what a market cycle looks like. We always see the market coming from somewhere, entering an accumulation phase, and then we see a markup, then we see a distribution, and then we see the markdown happening. This is a very simple cycle, guys, and the reason why I love this so much is because once we get used to seeing this cycle that happens over and over and over, hence the name cycle, it'll allow us to actually separate and isolate which phases of the market we're in. We'll be able to understand, are we in an accumulation phase? If we are in an accumulation phase, we should understand the probabilities that come with us trading during an accumulation phase. Are we in a markup phase? We will then be able to understand the probabilities that come with us trading or being a buyer in a markup phase. We'll also be able to isolate the trading opportunities that will give us the most risk to reward ratio depending on which phase of the market we are in. If we are in a distribution phase, we will then be able to understand the probabilities that come with us trading a distribution phase. Do you see how much this helps, guys? It's not just because we just want to talk about Wyckoff and it's just an interesting thing. It goes so deep, guys. It goes so far. And if we just understand the cycle, we'll basically get such a deeper, or a lot more deeper understanding as to how the market moves.